Sign a customer with $50,000 of debt at a 22% fee, and the contract appears to be worth $11,000. But on signing day, the company may legally collect exactly zero. That contradiction is the business. A debt relief company is not usually lending this customer money. It is not buying the debt, and it is not paying the creditor. It is selling negotiation and program administration. The customer may be asked to stop paying unsecured creditors and instead build cash in a dedicated account. Months later, when enough money exists for an offer, the company tries to settle each account for less than the balance. So the $11,000 is not revenue. It is only a possible fee attached to a long, fragile process. A consolidation lender advances new principal, earns interest or fees, and risks not getting the loan back. A payday lender does the same thing on a shorter, more expensive clock. A debt settlement provider generally advances no principal. The customer's savings remain the customer's money. The provider makes money only when enrolled debt becomes successfully resolved debt and a fee becomes eligible. That also separates settlement from several businesses using similar language. Nonprofit credit counseling and debt management plans usually organize repayment and seek lower rates or fees. Credit repair disputes information on a credit report. Student loan relief, mortgage relief, and bankruptcy services operate under different rules, and a real consolidation loan is still a loan. When an advertisement says debt consolidation or hints at a government program, the important question is simple. Are they offering a new loan, a repayment plan, legal service, or commercial debt settlement? This episode models the last one. Imagine a customer enrolls $35,000 of credit card and other qualifying unsecured debt. In our illustrative base case, the provider quotes a 22% fee, or $7,700, and a 36-month plan. The customer deposits about $620 a month into a dedicated account at an independent institution. Under the federal telemarketing rules conditions, the customer owns and controls that money and can withdraw it. The provider cannot treat the account balance as corporate cash. Meanwhile, missed payments can add interest and late fees. Credit scores may fall. Collection calls can intensify. A creditor may refuse to negotiate or file a lawsuit. The company can negotiate and administer paperwork. It cannot force a creditor to accept, stop a lawsuit by magic, or provide bankruptcy representation unless properly qualified to do so. The customer is building leverage, but also absorbing the risk. The FTC fee gate is specific. Before collecting a fee, the provider must successfully change at least one debt. The customer must agree to the result, the creditor's agreement must be in writing, and the customer must make at least one payment under it. With several accounts, the company can earn a proportional fee as accounts are resolved. It cannot settle one tiny balance and front-load the entire program fee. Our base case assumes the first collectible fee arrives around month 5. That is an editorial assumption, not an industry average. A small account might settle sooner. A large one may require much more cash. Some never settle. This is the difference between contract value, earned revenue, and collected cash. At enrollment, $7,700 of possible fees. After enough accounts resolve, perhaps only part becomes earned revenue. After funds transfer, it finally becomes cash. Before any negotiation, the company must find people in financial distress. Our hypothetical operator buys 2,500 leads per month from search, social platforms, affiliates, email, and lead generators. At $35 each, that is $87,500 of monthly media cost. Suppose 58% answer, 30% of those are qualified, and 20% of qualified prospects sign. The funnel creates 87 new clients a month. Advertising alone now costs about $1,006 per enrollment. Add a $600 sales commission and early service work, and a customer who exits before any settlement can cost about $1,900 while producing no fee. That is why cheap leads are not automatically good leads. The valuable customer is not the person who completes a form. It is the person who qualifies, enrolls appropriate debt, continues making deposits, accepts workable settlements, and remains through enough of the program for fees to become lawfully earned. The stated fee on our average client is $7,700. But our model assumes only 62.5% of enrolled debt becomes chargeable through successful resolutions. Expected fee revenue falls to $4,812.50 per client. Why? Some customers leave before the first offer. Some cannot sustain monthly deposits. Some settle only a few accounts. Some creditors refuse. Others may negotiate directly, resume payments, seek bankruptcy advice, or face litigation. An exit does not give the provider ownership of unspent savings. Unearned money remains the customer's. The provider keeps only fees already earned under the rule. This makes retention more important than the headline fee rate. In our base case, raising the chargeable share by 10 percentage points adds about $804,000 of annual revenue before incremental variable cost. But increasing customer acquisition cost by 25% removes $262,500 of operating profit immediately. The profit engine is a cohort, not a contract. Settlement marketing often confuses a creditor haircut with customer savings. Take a $35,000 balance that grows to $39,000 after missed payment interest and fees. Suppose creditors accept $21,450. That sounds like a dramatic reduction. Now add the provider's $7,700 fee and $600 of account and program costs. The customer pays $29,750 before any tax effect. That is only $5,250 below the original debt, not a 45% saving. And canceled debt may be taxable income unless an exception or exclusion applies, such as insolvency or bankruptcy. The exact result depends on the consumer's facts. A lawful provider can still create value. But gross forgiven principal, net customer savings, and provider revenue are three different numbers. Now, scale the cohorts. In the weak case, expensive leads, lower enrollment, and only 42% chargeable debt produce about $1.45 million of revenue. Costs overwhelm it, and the company loses roughly $1.26 million. In the base case, 87 new clients a month produce about $5.02 million of mature annual fee revenue. Advertising costs $1.05 million. Sales commissions take about $626,000. Service and negotiation take about $731,000. Software, payment operations, refunds, compliance, legal, and headquarters consume the rest. Operating profit is about $765,000 before paying the working owner. The strong case reaches roughly $6 million of operating profit before owner pay. But it assumes lower lead cost, higher contact quality, larger enrolled balances, faster settlement, and 72.5% chargeable debt. That combination is intentionally exceptional, not typical. The base case looks attractive only after cohorts overlap. At a cold start, advertising, commissions, payroll, software, licensing, and legal work are paid now. Our first fee arrives around month 5, and later fees arrive account by account. If year 1 collections reach only 55% of the mature run rate, the business can need roughly $1.5 million of working capital, despite profitable lifetime cohorts. The model breaks even around 58 new clients a month before owner pay and reserves. Below that, fixed compliance and management costs are too heavy. Above it, cash can grow quickly, unless refunds, lawsuits, chargebacks, or an enforcement action interrupt the fee stream. Federal rules are only the floor. States can add registration, bonding, reporting, fee limits, or different exemptions. California, for example, began requiring covered debt settlement providers to register in 2025 and started annual reporting in 2026. Compliance is not administrative decoration. It is part of the cost of goods sold. So, what does the owner of our hypothetical debt relief company keep? Not the customer's $35,000, not the $7,700 headline fee, and not even the full $4,800 expected from a mature client. After acquisition, sales, service, negotiation, technology, refunds, legal compliance, and overhead, the base case produces about $765,000 of operating profit. Pay the full-time owner a market salary of $180,000 and hold back $175,000 for legal and working capital risk, and about $410,000 remains as pre-tax distributable profit. That is the title answer, about $410,000 in our illustrative base case, plus salary for actually running the company. It is not passive, guaranteed, or an industry average. The real asset is not a clever promise to erase debt. It is a compliant machine that acquires suitable customers, keeps them depositing, resolves accounts, earns fees only after results, and survives the long delay between a signature and cash.